it's a very asset intensive industry or space. And so what we did that's different is we raised capital with the understanding that we would be investing across the capital structure of opportunities.
Welcome back to the Clean Techies podcast, where we interview ClimateTech founders and VCs to discuss all things building and investing to solve the biggest challenge of our generation, climate change. Today we have a pretty interesting capital provider joining us. Ethan Goldsmith is an investment partner at Keyframe Capital and helped found TeraWatt Infrastructure, the fleet charging behemoth. We went through the usual stuff around his background, early career, what they're doing, how they source deals, and their unique points, but the core of this conversation, in my opinion, is really in their model. Since their inception, they saw that ClimateTech would require more flexible capital structures, given the pure equity model wasn't going to work given how capital intensive most of these technologies are. They set up their fund to include those flexibilities. As an example, they might find a firm that is in need of funding. They could write a check in return for equity, but then in a few months, they might issue a specific project finance model for that use case. If the portfolio company needed to raise that in the form of equity for dollars, they would quickly be eradicating their cap table. This to me is the most important aspect of this entire conversation, and I'm glad we had the chance to speak with Ethan to go through it. Of course, there are other interesting topics that we talked about here as well, but this one in particular was very interesting and I think important for fund builders to consider as they are structuring their funds. So without any further delay, let's get into the episode. All right, welcome to the show, Ethan. How are you doing today?
I'm great. Thanks for having me. Excited to be here.
Yeah, super excited to have you on. So why don't we just kind of start from the beginning? Give us a bit of an intro to yourself and what you're doing today.
Yeah, absolutely. I mean, if we're going to really start at the beginning, I'll focus on a couple different stages of my career and then give you a bit of background on how that led to us forming Keyframe. And I know that we'll also get into a little bit on TeraWatt today as well, which was part of the evolution story. So why don't I just jump into it? So my background has always been in the really was originally in the automotive industry with an emphasis on vehicle electrification and how vehicle electrification was impacting both incumbents and startups in the automotive and tangential industries. I think a funny story back before that, my first job ever was washing cars at car dealerships. So I think I've just by some serendipity, have always been involved in the automotive industry in one way or another. But my first full-time job out of college was doing strategy consulting in the automotive space. There, I was mostly working with incumbents and helping them think about how the transition to electrification and other changes that were happening in mobility would impact their businesses. I did that for a few years and then had the fortunate opportunity to join an internal strategy team at Rivian, which at the time was about 70 folks, and spent a few years with them as they were at a really interesting inflection point in their business. They had a vehicle designed, a really stellar team, and needed to start raising the really massive amounts of capital that were critical to building an OEM. So spent a few years with them doing that. And during that time, I was introduced to the team that eventually became the founding partners of Keyframe and the founding team at TeraWatt. So that's John Rappaport and Ben Birnbaum. And we initially set up shop within Cyrus Capital, which is a investment manager also here in New York, and we had this high level thesis that really the energy transition at large was a unique industry from a startup perspective because it was a highly capital intensive industry.
Hey there. Quick break to remind any founders or VCs listening, if you are looking for deal flow, seeking to raise funding, looking for partners to help service your needs, or perhaps you're looking for corporate investment partners, feel free to reach out to us through our Slack channel, which can be found in the description. Because we meet a lot of people in this space, we set aside time each week to make introductions to the various people that we encounter. This is something we do free of charge in order to help these incredible companies solving climate change to scale. Looking forward to hearing from you in the Slack channel.
And because of that, there would be a need for a unique type of capital that traditional venture capital firms were not the right fit for, and that large incumbent infrastructure funds were not the right fit for. And that was largely driven by the fact that the energy transition, by its nature, is an asset-intensive industry. And therefore, you need capital that is well aligned with financing real assets, as opposed to some other areas of typical venture-funded parts of the economy, like fintech or SaaS, where there really isn't that asset financing need. So that was the overall thesis. And one of the subsectors that we focused on, and particularly with my background in the automotive space, was commercial vehicle electrification and the implications that would have on the grid, and the need for dedicated charging solutions to meet the future needs at the time of fleet operators who are transitioning their vehicles to who we believed would be transitioning their vehicles to electric vehicles. So while within Cyrus, we had that high-level thesis about the broader energy transition and what the right type of capital would, or at least what one piece of the capital needed to support the transition was. And we also had this thesis specifically about electric vehicle charging for fleets, which led to TeraWatt. So that's the groundwork for where we are today. And then we can definitely talk about it in more depth, but that those ideas spun two things. It spun TeraWatt and it spun Keyframe. And TeraWatt is now a standalone business with its own management team, and we are a capital supporter of that business. And Keyframe is an investment fund that seeks to solve that gap between venture-funded equity and large scale infrastructure funds in a number of different contexts. Mm-hmm. So let me pause there, and we can dive into any of those topics.
I think it's quite interesting that you talk about the need for kind of this gap between filling the gap between the infrastructure funds and the VC funds. I think when I got into this space in 2020, it seemed as though everybody was focused on anything that's software related. They weren't ready to take on hardware, essentially. I'm kind of curious, because you started before that. What really led you? Was that for you personally? Was that Rivian? But what about the rest of the founders? Like, what led you to understand that this was going to be an issue in particular? Because it's spot on, obviously.
I think, I mean, in the automotive context, I think it was, at least from my experience at Rivian, it was somewhat staring me in the face. I mean, building an OEM is an extremely capital intensive and real asset intensive endeavor. Building charging infrastructure is a real asset focused endeavor and I mean, on the vehicle side, there certainly is real technology risk and lots of innovation. On the charging infrastructure side, there certainly still is innovation that's happening, and we're getting faster chargers and more efficient chargers and things of that nature. But ultimately, the work to interconnect to the grid and the siting itself and all of the hardware that goes into building charging infrastructure is not tremendously tech risk related. So it was pretty clear to me that at least the parts of the energy transition that I understood well would be capital intensive. And then I think it was easy, at least for me, to translate that to other parts of the energy transition that I didn't understand as well, at least at the time, but could clearly see the capital intensive nature of. So, really all forms of renewable fall in that bucket. That even another focus area of our fund is building energy efficiency. Commonly, that includes both the software and hardware component. So the list goes on, and maybe just to touch on renewables, for example, one of the things that I found really interesting, just on its surface about renewables, is that renewables are 100% upfront capex investment with very low operating costs over the life of the asset, whereas traditional generation is still material upfront capex, but most of your costs for the life of the asset are operating expenses for your fuel. So it was just clear that the asset intensive nature of this transition was very real and touched both the industries that I knew well and the industries that I was learning about at the startup phase of Keyframe.
Hey there. Are you building a ClimateTech business and looking for very specialized talent? Consider reaching out to our sponsors, NextWave Partners. NextWave are experts in talent acquisition, recruitment, and retention across the ClimateTech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change yourself, feel free to reach out to NextWave at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page. Yeah, I'm kind of curious a little bit about, you mentioned at the beginning of your career, you've essentially always been interested in the car space in general, but would you say that, like, how was your realization to come to the focus of climate in particular? Was it that you were interested in cars, you thought Rivian was cool, and then you kind of found climate inside of that, or was it a little bit of a different story? I'm kind of curious to hear how you became specifically interested in the climate change space.
Yeah, I do think it's fair to say that my initial interest was driven by my interest in vehicle electrification. There were a couple of things that became clear to me as I started understanding electric vehicles better. One was really the climate impact and how important that was, and then another aspect was from a consumer experience, from a driving perspective, how much more enjoyable electric vehicles are, both to drive and to refuel, and that it was clearly just a better product. And that was at this point close to 10 years ago. And there's been a ton of innovation, both to make that product more affordable, and to make that product even more enjoyable from a user perspective. So I think I kind of got it came from that background, but it enlightened me that solving environmental issues can have a number of different wins, and certainly doesn't require sacrifice from a consumer perspective. Maybe that makes me a bit of a techno optimist, but I think that that's true in other parts of the energy transition as well. I mean, I'm not as intimately familiar with the technology, but heat pumps seem to be another kind of win-win-win in terms of environment, economics, and consumer comfort. So I will defend that statement for the automotive industry, and think there are many others that will defend it for other parts of the energy transition. So to your ultimate question, my interest came from the automotive context, but I believe that we can work on these problems in ways that are wins in a number of different verticals.
Yeah. I mean, one thing I also want to go into, which I think is probably helpful for a lot of people seeking to get into space, is, Keyframe is I'd say a pretty well-known VC. You do a lot of really, really interesting things. And I'd be curious to know if you had always had an interest in getting into private equity/VC, or if this is something that along the way you kind of fell into it. Could you talk us through a little bit about that early career journey and maybe some of the uncertainties, so that people can realize that everyone's human?
Yeah, absolutely. I think I've always taken a very open mind to what my career trajectory will be, and I think that's led me to some very interesting opportunities, both at the early parts of my career and now as in an investment role. I think that, from my perspective at least, there's a lot of value being at a operating company before joining the investment world, because it provided it particularly when you're working with earlier stage or mid stage companies, having had at least a few years of operating experience allows you to step into the shoes of a management team a little bit better than I imagine one could without having that experience. And I think that, I am fortunate from an education perspective to have some finance background, so that made the transition to a pure finance or a more pure finance role a bit smoother. But I also do believe that a lot of the finance skill set is slightly more academic and learnable than the true operating experience.
So maybe to kind of draw out from that, and correct me if I'm wrong, but would you offer the advice to somebody, young professional, kind of in their early stage of their career, who are interested in at some point getting into VC or private equity in particular in the space, to go work at an interesting portfolio type company or at an operating company first, probably a winner, if you will? You want to pick the right horse, I'm assuming, but would that be your advice, and maybe any tweaks on that?
I certainly think that there's value in that. I don't want to say that there's a right path and a wrong path, because there certainly is experience that I missed out on by not spending a couple of years as an investment banker and really understanding the deal process from soup to nuts before joining an investment role. So I don't want to predispose that there's a right or wrong path. I just am saying that I believe that there's value working for an operator. The one part of your statement that I would push back on is that you want to work for a winner. I think maybe the way I would adjust that a little bit is you want to work for a winning management team. And I think there are lots of winning management teams that, for a variety of reasons, work in businesses that are ultimately not the winning horse, because by its nature, a startup is a very, very difficult endeavor with lots of reasons that they could be unsuccessful, that may not be directly correlated to the strength of the team and the strength of the experience that you can get as a younger entry-level person in your career. So I think whether it's in this specific context that we're talking about here, or really in any time that I'm advising someone earlier in their career on what to look for, I always think that the number one thing is the immediate team that you're going to be working with, because working for a strong manager in a firm, in either a startup that isn't ultimately successful, or even call it a tier two, what would be thought of as a tier two firm, will set you up to gain the skill set you need to be successful long term, better than working for a poor manager in a successful firm or a tier one firm.
Yeah, I mean, that's a good point. I think it just serves as a reminder that it's not the company that makes you good. It's the people around you that kind of push you and help you to level up.
Exactly.
I'd like to just we have so many things to go over. We'll probably run out of time, but I want to have you walk us through a little bit about TeraWatt. I'm curious to learn more about the business, and then the big thing I want to hear from you is, what are your key takeaways and learning experiences from that process of helping build that from kind of the ground up?
Yeah, absolutely. So I set some of the groundwork about the origin of TeraWatt, but to give a little more context on how it's structured and how it was started and the evolution to where it is today. So the overall thesis is that electric vehicle fleets will have unique charging needs versus passenger vehicle fleets or consumer vehicle fleets. And that means that there will be concentrated charging in well-defined locations that are that work within a fleet's operating pattern with guaranteed access to charging at a high level of reliability. And I think probably most of the folks listening to this, or many folks listening to this, know that there are issues with reliability and access for the public charging network that probably are ultimately unacceptable for anyone, but certainly are unacceptable for a fleet operator. So with that thesis, we went out and began developing a portfolio of locations that we thought were well sited for this ultimate development. And we did that internally within, at the time at Cyrus and eventually within Keyframe, and started to build a portfolio of these sites that we thought would be well suited for the development into charging hubs. And we were able to incubate that as an investment team working for an investment fund as an investment, but with no dedicated management team.
Hey there, thanks for listening to this episode. If you made it this far, it's likely that you're enjoying the show, so I wanted to ask your help. If you're enjoying it, please give us a review on Apple Podcasts and share with somebody in the same industry who might find this interesting. And if you're interested in getting summaries of these episodes, go subscribe to our newsletter that comes out on LinkedIn and Substack. Links can be found in the description. Thanks for your help in growing the reach of this show.
We also this was all part of an underlying strategy that was developed in 2018 and in 2017. And at that time frame, we didn't have much transparency as to when electric vehicle adoption was really going to accelerate. We just knew that, or strongly believed that it would happen at some point in this decade. We didn't know if it would be early in the decade, middle of the decade, end of the decade. So we felt comfortable building an asset portfolio that would sustain until it was time to build it into charging hubs. And around 2.5 years ago, we started seeing more signs of credible mass production of electric vehicles. And for example, GM BrightDrop announcing that they were retooling their Canadian manufacturing plant to build delivery vans. Ford made a very similar announcement along the same time frame. I think it's for their Kansas transit plant that they were retooling to be an e-transit plant. And we knew those were a couple of year capital investments, but at the end of them, they would be producing at the very least medium duty electric vehicles in real volume. And that said to us, it was time to operationalize TeraWatt and build a management team that could take the portfolio of locations that we had started and really start to develop them. So we started a recruiting process, and I give a lot of credit to my partner Ben in doing so, but we networked in and were able to begin a fruitful relationship with Neha Palmer, who we hired to be the CEO of TeraWatt, and gave her the resources to build a all-star team around her. And that's what she's done. And that team's responsibilities are to really operationalize TeraWatt. So that's taking the site portfolio that already existed and starting to develop that, continue to build the portfolio, and then finally to work with customers who are rapidly adopting fleets and need charging solutions for them. And that's where we are today. And we're also fortunate to have brought in a great strategic capital partner alongside us. And we continue to invest together to properly resource both the operating team and the assets that are starting to go in the ground to build sites.
Mm-hmm. And so from all of this, what would you say was the biggest thing that you took away as learning personally for you? Because obviously this is still pretty early in your career. So I'd be kind of curious to hear the big things that you learned.
It's a great question. I think one of the biggest things that we learned is or at least that I learned, was know there's a lot that you don't know, and that you don't even know what you don't know. And power is a great example of this. One of the greatest challenges that TeraWatt faces is interconnecting its sites to the grid. And that is an incredibly nuanced, complicated, location by location, utility by utility process. And it's where we've been really fortunate to bring in Neha, and for her to have brought in a team with deep expertise in that competency, because it was something that I think I honestly was probably a bit naive about at the outset of building TeraWatt. Yeah, I think probably one of the biggest pitfalls is not being not at least accepting that there's things that you don't know about.
Mm-hmm. Yeah, I think that's great advice. I mean, I've had pretty early in my career, I had somebody teach me the same thing. That they tried to basically convince me to learn that before I actually had any issues. So I think I'm pretty grateful for that. But that's really great. I appreciate that insight. Okay, let's talk a little bit about you mentioned already the thesis behind Keyframe, or what eventually became Keyframe.
Sure.
But I want to just talk about, generally speaking, the strategy in a little bit more detail. Can you break apart for us the idea behind your strategy, the specifics of what you're doing in particular different than other VCs? I would classify Keyframe as a VC personally. I don't know if you agree with that, but if you just want to kind of walk us through the differences of what you're doing, and the strategy, and the reasons behind it.
Yeah, I mean, look, classification aside, I think what differentiates us from most traditional venture capital firms is the flexibility of our capital. So we, like I mentioned with the thesis here, we strongly believe that the energy transition requires asset financing to really simplify it, or financing that allows companies to scale the asset heavy aspects of their business, be that inventory, projects, even to some extent contracts that have upfront capital requirements. It's just I probably sound like a broken record here, but it's a very asset intensive industry, or space. And so what we did that's different is we raised capital with the understanding that we would be investing across the capital structure of opportunities. And that means that while we have the flexibility to participate in very traditional Series B, C, D equity rounds of equity funding, we find that we are the best fit and the most supportive of our portfolio companies when we're able to leverage our flexibility across the capital structure to help them solve a capital challenge. And that can really take a lot of different forms. So in some contexts, it's structured preferred equity that sits just in the normal capital structure of the business. In other contexts, it can be inventory financing. It can also be project financing, or it could be a fully unique structure like an opco-propco structure, where we're helping a business properly separate the risk characteristics of the business, so that while we can help across that capital need today, they're setting themselves up with a structure that in the future they can attract the lowest cost of capital, or the appropriate cost of capital for each element of their business. And we've and being able to leverage that flexibility has, I think, differentiated us a bit in the market, and solved a gap that we've seen to exist between the more venture focused and pure equity focused folks and the large infrastructure players that we really hope that a lot of our companies will grow into as they mature.
Mm-hmm. So this is interesting. I want to make sure I've got this and for the audience, if there's anybody unfamiliar. So in essence, typically VCs will just take an equity position, right? And the capital is used for essentially whatever. But you're saying that there may be circumstances, especially for these types of businesses, where maybe they need short-term debt, or maybe they need something specific that's not necessarily strictly equity. And you can provide another opportunity for them where it's not, hey, if you take this money, it's going to, cause dilution for you again in some way. So is that correct?
Yeah, that's spot on. And a lot of times it really wouldn't even be feasible to solve these challenges with simply equity, because the quantum of capital that's needed is at such a large scale that it would be too dilutive.
Yeah, there's only so many percentages until you get to 100.
Exactly.
Okay, interesting. That's very helpful. I think that's quite fascinating. I've never heard this this brought up in terms of a funding partner. So it's quite interesting to hear this. It's first time for me. I would be curious to understand a little bit. Maybe you mentioned earlier the particular verticals you focus on. It sounds like there's some flexibility there, but could you talk a little bit about the reasoning behind those verticals? I'm assuming it ties into this specific finance model.
Yeah, I mean, it does. I think what we've found is that this finance model is applicable to many aspects of the energy transition. I think that there's some parts of the energy transition have candidly already advanced beyond when we talk about those stages, right? From like a venture funded, still tech risky development type project to a project that can be fully financed by a traditional infrastructure fund. Some parts of the energy transition have really already gotten there. So utility scale solar, for example, or utility scale wind, there's no room in the capital structure for us, and that's okay, because those verticals have already gotten to the place where they can attract substantially lower cost of capital, and that's great. So we typically stay away from some of those more advanced more standardized financeable products like utility scale energy development. But in terms of other verticals that we focus on, I mentioned a couple of the key ones before. So there's vehicle electrification and related charging infrastructure, building energy efficiency. Another vertical that we've made a handful of investments in and continue to see opportunity is in the grid edge. So when we talk about the grid edge, we're talking about really the inflection point between where the utility stops, you're metered, and you hit your customer, your consumer, and that could be either a consumer, a household, a multifamily, a commercial building, and we think that there's still a lot of room for innovation at that node, and that innovation is the opportunity for that innovation continues to accelerate as more distributed assets sit on the other side of it, and there's more interaction between those assets and the grid. That node between the energy consumer and the grid becomes increasingly important. So that's a space that we've increasingly been spending time in. And then I think a space that we're starting to spend more time in, and we haven't yet made any material investments, but see a lot of opportunity, is in industrial decarb. So things like cement, steel, heavy energy consumers, where there may be a harder path to straight to electrification. um, is a space that we think there's room for our capital.
Mm-hmm. Yeah, that seems quite interesting. I mean, my thought process would be that I guess maybe you kind of look at solar, for example, and renewables as a whole, and it essentially got to a point where it was, it was proven enough that it was essentially commoditized, right? And they could get this low cost capital. I would assume the same thing may happen at some point to a number of these businesses. There are some tech risks and market risks, I would assume, especially in the EV charging space, but it'll be interesting to see how it evolves over time, and people's risk tolerance changes, because if at the end of the day, it's really just a matter of how do the investors view the opportunities, right? If they think it's
Yeah,
something super safe.
completely agree. And I think we will view success when those transitions occur, when we are no longer the appropriate cost of capital, and the companies that used to come to us for capital are now going to the mega infrastructure and PE funds, because they have further de-risked their technology and their projects, and can now very cleanly point to a return profile that's investable by those types of firms. So we think that that's like bringing some of these other industries to where utility scale solar and wind is today is the goal, and what we would consider to be a success.
Yeah, that's pretty interesting objective. It's almost you're kind of putting yourself out of a job in some ways, but it's kind of, I love those types of endeavors, right? um let's see.
Yeah, but
Go ahead.
sorry, just to quickly respond to that, I agree, but I also think there's a whole crop of earlier stage, still in the tech development phase, VC funded technologies that, as the technologies that are in our funding stage move up, will be backfilled by a whole new slew of technologies. So I think that it's a long time before we've truly completely self-obsoleted ourselves.
You just have to shift this just slightly, but this is okay. It keeps you on your toes, right?
Exactly.
That is a good point. That is a good point. This is the thing that I've been most fascinated by and hopeful for, is that the evolution of ClimateTech, by nature of it being hardware intensive, usually will create new models for hardware startups, because I think about how much innovation there could be inside of the hardware space. Even if you take climate out of the picture, if there was capital structures to make it work and things to make it like doable, and people with the risk tolerance, or the, at least maybe not risk tolerance, maybe that's the wrong thing. Maybe it's just the insight to actually make investments there and feel comfortable doing it. So I think it's pretty exciting.
Appreciate that.
One thing I'm kind of curious about is I always ask VCs or funds here, is how do you go about deal flow, and how do you decide on picking a company to work with?
Yeah, it's a good question. I think that what's really important to us is that we go very deep into an industry, and and truly understand not just the startups that are in that industry, but also what the incumbent and substitute technologies are for it. And through that deep engagement, we interface with as many people as we can in an industry, and like I just said, that's across the industry. That's incumbents, public companies, private companies, academic technologists. Really try to understand an industry. And when you go that deep into an industry, but by nature, you're going to meet the companies that are doing exciting things in the space. And by building those relationships and expressing who Keyframe is and what our capital options are, we maintain strong enough relationships to both interface with companies before they would be appropriate for our capital, and then be up to speed on both the company and the industry when they do. So I think that to summarize, our deep industry engagement is what drives a lot of our deal flow.
Interesting. I'm kind of curious from, I guess, more of an operational standpoint, if because of your capital structure and maybe kind of some returns to your LPs along the way, are you able to have more flexibility on the model? Because what I hear when you say this is that you're not just out there trying to, look at 1,000 companies and make, 20 checks per year. It's a certain type of model where you go into it, the deep research to understand the entire space, and then you can make a really good judgment on what to write a check for. So could you maybe speak to, is this made possible because of the innovative way you're having flexibility with your capital?
Yeah, I think one of the things that you're touching on, to maybe put it in a slightly different light, is because we're commonly the first structured capital into a business, we're spending a bit more time with a business than just an equity investor is, because we need to do all of the typical diligence that an investor does. And then in addition to that, we need to help, and we really view it as a partnership, work together to find the right capital structure and solution to meet the company's needs. So ultimately, that means I think we are probably spending a bit more time, at least at the investment stage, with potential companies than a firm that is just doing the equity style diligence and not as much of the structuring. And that's not to disparage any pure venture investor. That's just noting a difference in business model. And probably because of that, we may make slightly fewer and larger check size investments than someone that's just doing pure equity investing.
Okay. Interesting. Yeah, I appreciate that. One thing I'm also curious about is, and it might be only applicable to firms doing what you're doing, but I am curious about specifically, what is usually your biggest help or aid that you're able to, maybe aside from the kind of flexible financing that Keyframe is able to provide to its portfolio companies, either at the beginning or the middle or throughout the process?
Yeah, I mean, you said besides the structured financing, unfortunately, I do think that where we are the most supportive is when we are being flexible with our capital and helping them solve a real problem that only a flexible capital solution solves. And I think that we the way that we think about it is, it's not just at how we structure the investment at the beginning of the relationship. It's also how we work with a portfolio company over the course of a relationship to go from our initial investment to hopefully working with them all the way through the point where someone's coming in and offering them a term sheet for 10 times the size that we could offer and for half the cost of capital that we could offer. And being a thoughtful partner and I think that also involves not just the structuring of our investments, but how companies think about their complete capital structure, and being a good partner in that thought process. I do think that's probably our most unique value add. And then I would also add just like I said, when we source investments, a lot of it's through deep industry engagement. So by being deeply involved in the industries that we invest in, hopefully we're at least constructive in thinking about the way the company engages in their industry.
I mean, I would be curious. Maybe it's kind of under the hat, but I would assume that if you do such a deep dive on the industry, there's probably a lot of opportunities for connecting them with strategic partners along the way, that people that you've met and built relationships with. So I think that that could be an interesting value add that maybe others are not able to, at least in as much depth.
Yeah, I mean, I don't want to compare us to others in that regard.
Hmm.
I like to think that at least I know that many of the investment firms that we work with on ed companies provide a lot of value add contacts to the portfolio companies. So I don't think that's exclusively true of Keyframe, but it's certainly something that we try to do.
Hmm. Yeah, interesting. So, what would you say is your biggest advice to, especially somebody building one of these types of companies that's going to be capital intensive, won't be able to access private equity money right away, and may struggle with VC funding at the beginning? What is your advice to these founders? Because from the sounds of it, it sounds like there's a journey that they go through, and they get to a point where they're finally ready for, a keyframe type of investment. What is your advice to them as they're going about this?
Yeah, I think one of the things that we always look for is the unit economics of a business, and being able to fairly clearly articulate how the unit economics of your business works, what greatly widens the availability of funding, because it allows folks to look at the unit economics and say, okay, I know that I may have to make some assumptions about how many of these things are going to sell, but I have confidence in the unit economics of them. I think that's probably the, like, without being industry specific, that's probably the number one thing that I think folks should always focus on.
Mhm. Do people typically struggle with that? What are some, I guess, pieces of advice or maybe any resources that you'd recommend? Because I think, I mean, I would assume, again, I haven't seen these folks, but I would assume that might be something difficult for people to get their head around if they're not familiar with it already.
Um, I think there's varying degrees of thoughtfulness that we see when it comes to unit economics. But I think that the place to start is to start. I think more often than we see unthoughtful unit economic analysis, we see no unit economic analysis. And at least if you put forward a unit economics model or an approach, there's something to have a conversation about, and maybe we can help think through the way that assumptions were made in that in that unit economics, if it's not based on actuals, or if it's based on actuals, have a real conversation about it. But to not even show it at all makes it a more awkward start to the conversation.
Hmm. Yeah, I mean, obviously there has to be some types of metrics that you measure, and you can understand, hey, we need to hit X to achieve X, right? So that's interesting. Okay, very good. Well, we're running out of time, as I expected we would. We didn't get through everything, but I would like to know, at the bare minimum, for the final thoughts here, what is your, I guess you would say, obvious prediction over the next 2 to 3 years, that something you see as is pretty much going to happen, that maybe other people that you speak with don't typically recognize?
Can I think about that for a second?
Yeah, certainly,
Um,
certainly.
this is probably going to sound like an obvious answer to me, coming from me. So folks probably won't need to take that with a grain of salt. But I think we are truly at an inflection point in consumer electric vehicle adoption. And the reason I say that is uh, because there are already pockets of the country where 20 to 40% EV sales is becoming the norm. And that means that we're reaching a flipping point where it's no longer a corner case technology, but a cost parity, or at least total cost of ownership parity discussion, and a technology that is bending that is rounding the curve of being too new for consumers to adopt it, particularly in the more micro locations where we're seeing that high level of adoption. And I think so, and I think we're going to start to see it in many more locations than we already are. I think it's a classic S-curve situation where we are just at the point of the S-curve where we're rounding to the rapid growth stage. And I do think that's going to happen in the next 2 years.
Mm-hmm. Interesting. Yeah, I mean, I think some people might already believe that. There's a lot of people in the EV space, but I do think that it's interesting to hear your perspectives on the specific pockets, for example, that have these high adoption. It will be interesting to see. I can say this much. I see more and more electric cars every day, and maybe someday I'll convince my dad to get one, but we'll see. When that day comes, I think the the late stage adopters will have already hit the market, right? But anyways, this has been really great. Any other final thoughts to leave with the audience, things that your asks, offers, or where people can reach you?
Yeah, I mean, first of all, in terms of where to reach me, I think I'm pretty accessible. My email address is just my initials, eg@keyframecapital.com. And in terms of final thoughts, I think I'll end with this a statement that with really where I started. I'm as optimistic as I was when I started to enter this industry about that trifecta of positives surrounding the energy transition, the combination of superior economics, superior consumer experience, and superior environmental impacts. And I think that is more true now than it was when I had that realization. So I'm continue to be very positive about the trajectory that we're on.
That's great to hear. I always love to hear the way that you've gone through the journey and how you started, and especially that now that you're in it, you're even still positive about it. So this has been really great. I think I just want to say this is quite fascinating for me. I mean, I have a lot of guests on, but it's very interesting what you guys are doing, and very keen to have been able to speak with you. So thank you so much for joining us, and we'll have to have you on hopefully again in the future and see maybe some of your portfolio companies.
Yeah, appreciate that, and definitely, and hopefully the next time we chat, a bunch of the focus industries that we focused on have moved up the cost of care, down the cost of capital curve, and we're talking about a whole new set of industries. So that'll be
Certainly.
fun.
Yeah, absolutely.